Let's talk about the large capital budgeting project problems that are in Chapter 10, homework problems, questions 1 through 5. So we have Aero motorcycles and they're considering opening a new manufacturing facility. And we've got a lot of information in here. And questions 1 ask about the cash flows in the first period. Question 2 ask about the cash flows in the second period. Question 3 asks about the after-tax salvage value. Question 4 asks about the cash flow in the last year of the project. And finally, question 5, we are asked, what is the project's NPV? And then from there, we would make a decision whether to accept or reject the project. So let's work through, now in your particular problems that you're going to be receiving, question 5 has some different numbers. But we're going to solve this today just using the numbers that are in questions 1 through 4 because of all those numbers are the same. So let's go ahead and get started. So rather than just trying to solve one of these, I'm going to go through the entire problem from beginning to end, all the different cash flows we have to calculate so that we can compute the net present value. So I have all this information over here, but just to kind of review real quick, the firm spent $300,000 for a marketing study. So that money's spent. So whether the company does the project or they do not do the project, they've still spent the $300,000. So because it's not relevant, we classify this as a sunk cost. It doesn't matter whether we do the project or not. Therefore, we're just going to ignore it. Money that's already been spent and we can't recoup no matter what, it's not relevant. All right, so the next bullet point says that they purchased the land 5 years ago for $2 million, and that's its book value. It also tells us that it doesn't have a mortgage, which we don't really need that information anyway. And the land has a current market value of $2.6 million. Now, before, right, we wanted to ignore sunk costs, but we want to include opportunity cost. And this is an opportunity cost of $2.6 million because if the company doesn't do this project, they have the ability to sell this land for $2.6 million. So by doing the project, they forego selling the property for $2.6 million. So therefore, the opportunity cost is $2.6 million. So we're told that excluding land, the project has an initial cost of $20,000. Now we can't depreciate land, so this is going to be the cost that we can depreciate each year on an annual basis. And if we do the project, we have to make some investments in net working capital. So we've got to increase more current assets, inventories, and accounts receivable. That's going to be offset by the accounts payable. And we're going to assume that all this investment in net working capital, we're going to recover that at the end of the project's life. As far as sales and cost, if the company does the project, they're going to get $8 million in additional sales over the next 10 years. With an operating cost that's equal to 50% of sales. And that operating cost does not include a depreciation. The tax rate is 35%. We cut a break here. We're going to use 10-year straight line depreciation instead of makers. So we can calculate this one time. And at t is equal to 10, so year 10, the project is expected to shut down. It's no longer economically viable. And we're going to sell a project for $4.5 million that includes the land that's sitting underneath that factory that was built. And we've got a cost of capital, weighted average cost of capital for this project of 10%. And if the firm is profitable, so any tax credit, negative taxes, that's going to be a credit. So let's hop right in. I've got this here in Excel. So let's first start with the cash flows at time zero, our CF0 in our financial calculator lingo. So we have an opportunity cost of $2.6 million. We have the initial cost of $20 million, and then we have that working capital investment, which, let me just click on that real quick. That is going to be the investment in inventory plus the investment in accounts receivable less the accounts payable because our vendors are kind of financing some of this for us, right? That gives us a total cash flow at time zero of a negative $25,600,000. And then we have the operating cash flows for the next 10 years. So we're told sales are equal to $8 million. Operating costs are 50% of sales, or $4 million. So that gives us an EBITDA, earnings before interest, taxes, depreciation, and amortization, of $4 million. And then we need to calculate depreciation. So let's hop right over here and let's talk about depreciation. So in straight line depreciation, if we go to Investopedia, or if we go to, if we go to Investopedia, or if we go to the Chartered Financial Analyst Guidelines, the way we calculate straight line depreciation is different than the way we calculate the modified accelerated cost recovery depreciation, in that for straight line depreciation, we take out the estimated salvage value. Now, in practice, most companies don't actually do this, but that is kind of the textbook way to do it. So that's the way we're going to be doing it in this class. So if you're doing this and you get out and your employer says, what are you doing? Why are you taking out depreciation? Why are you calculating depreciation by taking out this net salvage value that's going to occur in 10 years, but it might occur, it might not occur, it could be more, it could be less. Why are you doing this? Why don't you just ignore it? So keep in mind that that may be the case, right? But as far as to be consistent with the Chartered Financial Analyst, so even though you're going to be setting for your CFA designation, this is the way it's calculated. So we have the cost, the depreciable basis is $20 million, and we can sell this in 10 years. This gross salvage value is $4.5 million, but $2 million of that is the land value, and land does not depreciate. So whatever we purchase land for, that's the book value of the land. So we take that out, and that gives us a net salvage value of $2.5 million. And we have 10 years straight line depreciation. So we have that $20 million. We're going to depreciate that over 10 years, but we have $20 million less than the net salvage value of $2.5 million. So what we have then is $17,500,000 of total depreciation. Right? So our annual depreciation then, or 20 million less the 2.5 million, 17.5 million, divide that by 10, that gives us an annual depreciation charge of $1,750,000. So let's jump back over here to our estimating our operating cash flow. So there we have the depreciation charge per year, $1,750,000. Deduct that from our EBITDA. That gives us an EBIT, earnings before interest and taxes, of $2,250,000. We're going to pay taxes on that amount to the tune of 35%, or $787,500. And that gives us our NOPAT, net operating profit after tax. This is not the same as net income, right? Net operating profit after tax of $1,462,500. Because nobody actually writes a check out to Mr. or Mrs. Depreciation, it's a non-cash flow event. It affects our taxes, but it doesn't actually, there's not a depreciation cash flow. We're going to add that to the NOPAT to arrive at our operating cash flow of $3,212,500. Now, what happens in the last year? So we call that the terminal year. So that terminal year, we're going to get back our investment in net working capital. We're going to sell this project for $4.5 million. And then we have to figure out, do we owe any taxes on this sale of $4.5 million? So we got to back out the book value, excluding the land. So not counting the land. What's the book value? Well, it's going to be that $20 million less the depreciation that we had accumulated so far. So we had 10 years of depreciation at $1.75 million per year. So $20 million less the $17.5 million. That gives us a book value for the building, the improvements on the land, of $2.5 million. So we add back in the $2 million book value of land. So the combined book value of the land and the project then on our accounting records is $4.5 million, which is exactly equal to our sales price. So we have a taxable gain of 0. We could have had a taxable gain that's positive, negative, which would be a tax credit. So because we don't have a taxable gain, we don't have taxes to pay. So our after-tax salvage value in this particular case is the same as the sales price. Typically that's not the case, but just in this particular problem it is, right? Then we also have the operating cash flow for year 10, and that gives us a total terminal year cash flow of $10,712,500. So we can solve this a couple of different ways. We can use our financial calculator, or we can use Excel's NPV function to solve for this also. So either way is going to yield us the same answer. So just real quick, going through the financial calculator, we hit that CF button on our financial calculator, hit second, and clear work. The clear work's down the lower left-hand corner button of your calculator. Put in, and after you do that, you should see CF0 equals 0 or something like that. Put in negative $25,600,000, enter, and then down arrow. You have to hit enter. If you just down arrow, it's going to not remember the number. And then we're going to put in for C01, the $3,212,500, enter, down arrow, frequency, that happens 9 times. Now we have this operating cash flow happening 10 times. Remember the 10th year, we have the operating cash flow and all those other terminal year cash flows, so that happens 9 times. C02 is $10,712,500 with a frequency of 1. Then we push the NPV button on our calculator, and it asks us for I. I is equal to something. That's our weighted average cost of capital. It's 10%, so 10, enter, down arrow, and on your display you'll say, oh, NPV is equal to 0. No, you have to hit the compute button. So hit that compute button and you get an NPV here of a negative $2.9 million. Obviously we would reject this particular project, and here I've included this spreadsheet here, but in Excel we've got to list each one of those cash flows in order, and then use the NPV function, tell it the interest rate, and have what's the range of cells for the future cash flow. Now keep in mind, in Excel, the NPV calculates the present value of the future cash flows, and we have to add back in or subtract that negative cash flow that occurs at time 0 ourselves. All right? So either way we get the same result. Have a great day, Mavericks.